out of the mattress and into the markets. It's easy to be scared by all the bad news, but your money isn't going to grow unless you put it to work. An ETF trades like a stock but offers more transparency. You know what you're getting. You buy shares in an exchange-traded fund, and the fund owns a diversified portfolio made up of stocks, bonds, and commodities, so you get the broad exposure without the massive risk. Christine Benz is the Director of Personal Finance at Morningstar. Christine, give me the top 3 ETFs an everyday investor should know about.
For aggressive exchange-traded fund investors, one I would look to is called Wisdom Tree Emerging Markets Small Cap Dividend. The reason I like it is that it owns regional, small companies in emerging markets. So it's going to not be beholden to what the total global stock market is doing, but it'll be more beholden to region-specific or market-specific factors. So I think it will actually give investors a better flavor for what's going on in emerging markets than will some of the broad emerging markets index funds, because they're dominated by essentially global companies.
Emerging markets can be volatile. Christine, what if an investor wanted more growth and less risk?
For core ETF exposure for more moderate investors, one fund I would point to is called Vanguard Dividend Appreciation. And this is a basket of very solid blue chip companies, a lot of household names here, cash flow rich companies that in general will tend to be pretty all-weather. So these are generally companies that held up pretty well in a turbulent market environment like 2008. This fund is really easy to recommend for core stock exposure, and like all Vanguard funds, it's nice and cheap too, which is another plus.
Vanguard Dividend Appreciation ETF only chooses companies that have been able to raise their dividend in the past 10 years, but blue chips have been beaten down with the broader market. So Christine, what's the least risky ETF that you can recommend?
For conservative investors, one fund I would check out is called iShares Barclays TIPS Bond. And this is a fund that owns a basket of Treasury inflation protected securities, or TIPS. These are bonds issued by the US government, but they also include an element of inflation protection. So if you own TIPS or a basket of TIPS like you do with this fund, you actually get an adjustment in your principal value upward if inflation rises.
With ETFs, you can use good old trading techniques like buying long, selling short, and using stop and limit orders, but you do buy shares through a broker, so normal fees apply. And before you invest, always do your homework to find the right ETF for you.